The pitch for Dubai real estate usually relies on a very specific promise: buy a luxury property, secure wealth, and get your UAE residency effortlessly. In 2026, the government actually did remove the biggest hurdles for property visas. The 750,000 dirham minimum requirement for a 2-year Taskin visa is gone. And if you want the 10-year golden visa, you no longer have to prove you've paid 50% of the property value up front. This policy shift supports the D33 agenda. The Emirate is aggressively transitioning its economy away from oil and towards services and global transit, anchored by massive long-term infrastructure plays like the $35 billion expansion of Al Maktoum Airport. The state has eliminated the immigration friction to attract global capital. But because the entry barriers are lower, the raw financial risk of the underlying property now sits entirely on your shoulders. To navigate this, we have to isolate exactly what kind of buyer you are. The first profile is the lifestyle visa seeker. Your primary goal is simply securing UAE residency, and you want to deploy the absolute minimum amount of capital required to get it. The second profile is the yield-chasing speculator. You are drawn in by marketing brochures advertising 8% or higher gross rental yields, and you plan to use highly leveraged off-plan payment plans to maximize your returns. The third profile is the high net worth wealth preserver. You are looking to park substantial capital in a tax-efficient environment, set up generational wealth transfer, and secure the 10-year golden visa for your family. These three buyers require completely different assets. Applying the visa seeker's budget to the speculator strategy is a fast track to toxic investments and heavy capital loss. Let's look at the 2-year Taskin visa. By dropping the 750,000 dirham minimum threshold, the market is suddenly open to low-budget buyers who might only afford a small studio. Warning tone. The catch is strict. The property must be 100% physically complete, and you must hold a registered title deed from the Dubai Land Department. The 10-year golden visa offers more flexibility. With the 50% upfront payment rule abolished, you can now qualify using a mortgage or a developer's installment plan right from the start. But this creates the off-plan trap. Your 10-year visa application remains blocked until construction reaches a specific milestone, usually 50% completion. If your income drops and you default on your payment plan before handover, the developer cancels the contract and your visa basis vanishes. Residency rights in Dubai are strictly conditional on physical, registered assets. An off-plan promise from a developer does not grant you the right to live here. If you are chasing cash flow, high-density apartment corridors hold an obvious appeal. These units consistently post the city's highest gross rental yields, often clearing 7 or 8%. But this split bar chart shows the severe risk of the incoming supply wave, known as the materialization gap. We are looking at a projected pipeline of over 350,000 apartments scheduled for delivery through 2029. Compared to a highly constrained pipeline of roughly 16,000 villas and townhouses. This heavy concentration of apartment inventory means secondary, high-density locations are highly vulnerable. As those units hit the market, landlords face localized rent stagnation and extended vacancy periods. The villa market operates under the exact opposite conditions. The strict structural undersupply of low-density housing protects their capital values, even as the wider population grows. This scarce, low-density asset class commands a premium entry price and yields less raw rent, but it offers a much stronger defense against market fluctuations. You must choose your trade-off explicitly. Pursue high yield while accepting heavy supply risk in apartments, or accept a lower yield in exchange for strict capital preservation in villas. Calculating your return on investment using the gross yield printed on a developer's marketing brochure is financially dangerous. This waterfall chart begins with an advertised 8% gross yield, but immediately factors in the unavoidable transactional friction. You lose a mandatory 4% transfer fee to the Dubai Land Department, plus a standard 2% agency commission, just to close the deal. Then subtract the ongoing Rera Malak service charges, the annual maintenance fees priced per square foot. Once those are deducted, your true net yield is drastically lower than the advertised number. You also have to structure the ownership correctly. Natural persons managing their own real estate are exempt from corporate tax. But if you try to hold that same property through a free zone commercial entity, you face strict substance rules and expose your rental income to a 9% corporate tax rate. Listen carefully. If your investment math only works when you look at the gross yield, the deal is mathematically flawed. The ultimate rule for navigating Dubai in 2026 is this: you must evaluate the real estate asset exactly as if the residency visa did not exist. This flowchart maps the optimal strategies. If you are the budget visa seeker, your safe path is acquiring a completed studio. The off-plan payment plan is a trap. Buying on the secondary market ensures you get an immediate title deed. You bypass the risk of construction delays and secure your residency without waiting years for a handover. If you are the yield speculator, avoid ultra-luxury towers where high service charges crush your net returns. Your target should be mid-market apartments with direct infrastructure links. Properties within walking distance of heavy rail, like the Dubai Metro, maintain intense tenant demand and hold their rental value, even when thousands of new units flood the broader market. For the high net worth wealth preserver, the strategy relies on scarce villas in established master communities. You pair this physical asset with a DIFC or ADGM family foundation, a tax-transparent vehicle that shields the wealth and ensures seamless inheritance. Matching the correct asset class to your liquidity timeline is the only way to ensure you are never forced to sell during a market dip. Dubai offers a zero-tax, frictionless capital environment. The trade-off for that freedom is that you have to act as your own strict financial regulator. Before you ever sign a sales and purchase agreement, you must verify the developer's escrow compliance under Law Number 8 to ensure your funds are protected. You must also pull the historical Malak service charges to calculate your real net yield. The 2026 market rewards disciplined math over emotional marketing. The government has cleared the path to entry, but the safety of your capital is entirely in your own hands.